G'day guys, welcome back to Money in the Tank, episode 67 today, I believe. Brad, we didn't actually check that one today. Usually we check it before we start the pod, but
67 I think is a good guess, Joel.
67 is a good guess. We're back and we're with you guys live. We're just chatting off air about the markets and then the upcoming inflation figures that are coming up soon. So we'll be able to bring a bit of live stuff to you guys today, but welcome back to the listeners out there. It's good to be with you again. 2 weeks in a row. We're doing well so far. We're a man down with Arnie not able to make it with us today, but we've got our special guest back for take two. You guys didn't get take one because we had a malfunction, but take two, and it'll be the first take in your eyes, listeners. We've got Ash Woodhead from Evans and Partners. Say good day, Ash.
G'day, guys. Nice to be here.
Good to have you. Good to have you. We'll get back to Ash just in a moment. And then down below my screen here in the blue T-shirt there from Singapore.
Brad Tabone, Generalist and Investor.
And my name's Joel Seach, Principal Advisor, Harpel FG. Good to be back today, guys. And we do have a special guest on, Ash Woodhead, today from Evans and Partners. Ash is a investment advisor. So we're going to jump to Ash in just a moment, I guess, to talk a bit about that and what we're seeing in the markets of late. So there's plenty to get through today, guys. So yeah, obviously some of the latest stuff out of the Fed, what the RBA is going to be doing upcoming this next month. We're going to talk again to Ash and Brad about the market expectations for the year ahead from a macro view, maybe even some micro stuff about what we're feeling about the calendar year or the financial year moving forward. We've also got a really good third, if I do say so myself, that I've put together today for a special guest with Ash, given the last one didn't quite work out so well. And we've got a Rivkin's rules as well. So plenty to get through today, and we're going to try to knock it out for you guys in the most efficient way possible. Before we get to Rivkin's rules, guys, anything extra that I forgot to do? Oh, Brad, where can they get us at?
Let's say they can find us on Facebook, Instagram. They can find us on all the best podcast places, Spotify, I Love Podcasts, all the rest of it. We are everywhere. So go on there, subscribe, and if it has any sort of functionality to send us stuff, send a comment. Tell us what you want to hear, and or your feedback on what you have heard, please.
We love it. We love the comments. We love the questions. We do have a Q&A today as well, which we'll throw to at the end from one of the listeners out there. But without further ado, let's get stuck into Rivkins. So we've got the Bible up in front of us here. We're going to throw to page... Oh, here we go. Renee on politics. So this is always an interesting chapter. I've hit a few of these off already, so I'm just clicking and there we go. No, we've done politics. So we're Renee's favourite Rivkinisms we're on now. So we've ticked off all the politics ones. We've gotten through a fair few of these. I'm running out of Rivkin's quotes, unfortunately, because I've ticked off so many of these as we've gone. Here we go. The press calls me flamboyant. I don't know exactly what that is, but it seems to have helped my career, so I'm prepared to accept the term. I would agree that I'm eccentric, as I am unquestionably different to most people. There you go. That's Renee's favourite Rivkinisms. So flamboyant man. I don't know what we can make of that.
All I can say is I like how he says he doesn't know what it means, and he starts bringing eccentric into it and all the rest of it, and it helps his career. Somehow I do think he knows what it means.
He was the sort of the flamboyant stockbroker guy back in the 90s before it became a new thing, and the market capturing attention of the people we see nowadays on social media and the headline grabbers. He was probably one of those early trailblazers of that.
It was like an early stage, like Tate almost, right? He's a bit of a eccentric guy with big cigars out in front of like convertible cars.
Do you remember Rivkin back in the day, Ash?
No, look, I know the name, but I can't say that I'm a Rivkin follower. Although I've been learning a little bit about him following the podcast, of course.
There you go. Yep. Renee back in the day. So he was the stock sort of quote unquote guru back in the 90s, I think it was. So I haven't had his Bible, but we're getting through all the pages, so we're going to run out of them soon. So we're going to have to find another Bible. But anyway, without further ado, let's get stuck into the pod today. So I guess in terms of touching on the latest topic, so we might have some inflation figures out shortly. Ash is keeping a bit of an eye on the market there from his end.
Yeah, we do.
Have it gone? Yeah, because it gone one way or the other, and then.
Yeah, what are the latest inflation figures?
Well, the year-on-year monthly numbers are 4.9 for July, so down from 5.4 in June. The market's jumped up about, it's jumped up about 0.2%. It was already having a good day. So we're up 1.1% now for the day. So a little bit better than what the market probably expected. But the trend continues.
Was the consensus expectation, I think I read maybe 5.2 of expected?
It was around, a little bit above 5, around the 5 mark. So slightly below it. It's not a full CPI basket, the monthly. So it's not as much weight placed on the monthly as the quarterly, but it's still a reasonable indication, and it highlights sort of where inflation's heading in Australia, which is no different to what we've been seeing over in some of the other developed markets overseas.
So I guess throwing to Ash now in terms of your role, and we'll get to that in just a moment, but what do you, from inflation figures like that, what do you then expect to see out of the markets when you see those figures come through, and what does that mean for, for your regular, listeners out there, and, what we're seeing with the inflation at the moment?
Yeah. Okay. Yeah. So with the inflation, what's probably been really surprising over the last 6 months, particularly, has been the speed at which it's come down, but then the resiliency of the economies at the same time. So I think most economists had predicted that in order for inflation to come down, in a relatively steep manner, it was going to require unemployment to go up. That's sort of the playbook. What's been a real head scratcher for most of the economists around the world is that, particularly Australia and the US, is that, we haven't seen unemployment really rise at all yet. And yet we've seen inflation come back down, getting pretty close to, especially in the US, to the target level. So what that means for investors is that if inflation's coming down in quite a steep manner, it provides less incentive in the short term for central banks to raise rates further. They can sort of sit there and just wait and see the data and ensure that the economy continues, or the supply demand of the economy continues to balance out nicely, and won't feel as much pressure to raise rates further or much further to suppress demand, which is basically what they're trying to do, is raise rates, suppress demand, so that inflation comes back down to a more manageable level. So these sort of things that come out like today, that'll be a positive for the central bank. They'll be happy to see that. Means that they're still on the right path. What they've done is working, and now it's just a matter of probably sitting tight, not doing too much in the short term, if you're the central bank, and just keep watching the data and making sure that it keeps on the trend that's going on.
And the market reacting positively to that. So off the back of that is what you were mentioning there is, the market seeing the inflation rate coming down, the economy is stable. They're all good signs from a market perspective.
Yeah, exactly. So there's a couple of reasons why the market sees that as a positive. Firstly, it means that if interest rates are not going much higher from here, that is what you see as the risk-free rate, or that's effectively what every other investment is pegged against. So, if you can get 4.1% or even 5%, let's say, in a government guaranteed term deposit, you need other investments to be able to achieve more than that in order to take some risk and invest in those other assets. So a few months ago, the market was expecting that interest rates were going to get to the high 4s, the cash rate, which we're still at 4.1 right now. So with a higher terminal rate or cash rate, peak cash rate, that just means that every other investment, really does have to be devalued according to that. So now that those expectations are coming down, that the expectation that interest rates aren't going to go quite as high, that's a positive for valuations on other investments, because you think equities typically will generate, when you take into account dividends and you take into account earnings growth, will generate more than that sort of cash return. So the equity risk premium is greater than what we thought it was 3 months ago. So it's a positive for other asset classes.
And I guess Brad and myself and Arnie last week were chatting about on the pod, and that's a great summary of that. But I guess where do you feel with the interest rate domestically? We're sitting at 4.1. You know, the Fed over there in America is 5.25 to 5.5. So we've got about 1% difference, a bit above that. Is there a risk factor of us falling behind the rest of the world with their rates, or are we separate enough where it's not a concern? Do you see have you had much commentary around that? Ash, if that makes some sense.
Probably like into FX, like the impact on
foreign exchange as well, yeah.
And the rest of it, obviously, we've been hit quite hard, and forecasts are due to that kind of gap, and lower demand out of China. I think double whammy for the Australian dollar. And it's probably heading under 60 cents, probably. Have you heard it? What are your thoughts around that, mate?
Yeah, it's really interesting. The exiting central bank chair Phil Lowe did state recently, in the last 12 months, that's not a factor in his decision making around rate rises. Foreign currency and the Aussie dollar versus the US dollar.
Employment, inflation.
He's correct. So employment and inflation are the keys. So that's what they're focused on. It's not their job to look at the current, it's not one of their primary objectives to focus on currency when they're making decisions. I mean, there is a real impact potentially there in that, if we sit at 4.1 and US continues up to close to 6%, that difference is quite significant. But I don't think it's going to be a primary focus for the RBA in the short term. And ultimately, the higher the US rate gets, the more likely it is that will push their economy into challenges. And what we're seeing out of the US is, positive as well. I mean, their economy is doing well, but employment's starting to show signs of weakness finally. So, they may be able to pause as well in September. And then they've got, I think, November and December to go. And, they may only have, one more rate rise to go from here with all the data that we're seeing come out of there. So, I don't think it's a major focus for the RBA. I do, the Aussie dollar has been weak, a lot to do with China and, perception around risk and demand for our currency. But we're still running with very strong, with a very strong trade surplus. So we would like to think that in time, things will normalise and we'll get back to sort of high 60s to 70 cents, which is around that sort of power purchase parity figure.
The interesting thing is that our trade surplus in terms of what we are kind of exporting out there is very, very healthy. And so do you think it's more of a perceived, with obviously Evergrande and Century and the latest one, I always forget the biggest developer that's just
Country Garden.
Country Garden, not Century Garden. Do you think it's more of a perception of, okay, well, if they're having continued issues, there's going to be less demand for our, iron and the rest of it. So therefore, that kind of it's built into the dollar, and when that's kind of shown not to maybe be the case with continued trade surplus the way that it is, that if we kind of see that maybe we're trading with other countries, it's not just China anymore.
Yeah, I think it's a lot of perception around the regional risks, and where we're seen as we are a risky currency relative to the US. US is a safe haven. It's been a strong currency in general, so it's had a really strong bounce against the basket of developed currencies in the last little while. And so it's not just an Australian dollar story, it's actually a US dollar story as well. But yeah, certainly the perceived risk around slowing demand coming from China, the stimulus from China, the Chinese government has not been anywhere near what was expected. Although, their economy, while it was, technically was in deflation as of June. No, look, it may have swung too far to the other side in terms of how negative everybody is about that economy at the moment. But certainly the Aussie dollar has felt the impacts of that sort of sentiment in the last few months.
Yeah. Love it. So it's a really good recap, I guess, on what the rates have done in the Fed, what our RBA rates are doing at the moment, what employment's doing. It's an interesting topic to see why employment has been so sticky, unemployment or full employment has been so sticky, and it's taken a while for the unemployment figure to rise. Both here domestically in Australia, I think we're really low. We're still about 3.5, 3.6. And then America, obviously, in the Fed as well, has been, sticky for so long there. So and that seems to be a worldwide theme at the moment. Just unemployment's super low, which, as we've spoken about before, the economy doesn't love to have super low unemployment. It likes to have some wage, not too much wage pressure, I should say, because that's sort of what drives inflation as well. When you got wage pressure and full employment, people can demand what they want to get paid. You want to have that balance there. I guess in terms of the RBA, just quickly before we get to throw to Ash to talk a bit about an investment advisor role with the RBA, we've got the new lady coming in. Is it Michelle Bullock? I think Shelley. We nicknamed her last week. Michelle Bullock, who's the new Fed chair. The RBA governor. Coming in next month. I read before that I think it's a 96% chance of no movement in her first meeting. So that seems to be pretty unanimous that there's not going to be any movement. And I guess the figures coming out today would start to sort of talk. You start to see some commentary probably around when might be the first cut over the next 6 months or so. What do you boys think about that, Brad and Ash?
Yeah, look, I can go. Certainly, we're probably right near the top, and we can get to investing later. But we probably do think that if we've got any rate rises left, it's probably only one from here based on the trajectory of CPI and some of the challenges that are starting to come through from not delinquencies, but arrears. We're certainly not at high levels with mortgage arrears, but it's sort of certainly trending in the wrong direction from very low levels. So it doesn't feel like there is any sort of reason for the RBA to sort of push any harder in the short term. That being said, things can change. The economy might bounce back, and all of a sudden, in 3 months' time, where we are talking about more rate rises. And earlier this week, the retail sales data that came out was ahead of expectations. So it shows that the economy itself, there is different baskets in the economy. You've got the baby boomers who are probably feeling pretty good right now. They're getting a lot of income from the fact that interest rates are higher. And then you have, the people, the mortgage belt and people in their 30s and 40s who are, heavily indebted that are probably battling somewhat. So I think, from here, we're probably feel pretty comfortable that the RBA is going to hold tight for at least a couple of months until we see any more data to the contrary. But in terms of dropping rates, I'd be very surprised if there was anything that came through in the next 6 months for a rate drop. We're to your point earlier, we're lower than what a lot of we're certainly lower than the US. They haven't gone as hard as what they could have, i.e. New Zealand. So I feel like, we're sort of walking a balance beam quite well. And yeah, the need to lower rates, you'd need to see some pretty bad data coming out later this year or early 2024 to instigate a fall in interest rates. Perhaps 12 months down the track is too far to predict, but maybe 12 months from here, it could be a different story.
Yeah, it's interesting. And I guess it's anyone's kind of guess at the moment as to with the new chair coming in and where as you said, they're month by month kind of reviewing these figures, and there's so many moving parts to it at the moment. And then we've got the rest of the world as well to sort of, even though they say don't really take that into account, they've got to understand and take that into account, I think, as to what the other parts of the world are doing as well. Brad, what's your thoughts with, obviously you're abroad now, but from a local situation with the RBA, where do you feel they're going to go with interest rates over the next 6 to say 12 months? Do you feel there's another rate hike in them, or do you feel like they're tapped out now and the next movement would be down when they do move?
Yeah, I think they're going to watch arrears. I mean, I know they're not like historically high, but they are coming off a very, very low base and growing. So I was just having a look at arrears at the moment across the country, and you're sitting at about between 2 and 3% at the major banks. So major banks go from 1 to 3%, sorry. And you've got the kind of non-standard 4 banks out to even 7-8% of arrears. So the arrears are growing. So your non kind of like, the Victorian Mortgage Group and Peppers and all that, they're all kind of gone from, only a year ago, 1%, and they're out to like between 5 and 8%. And then, 1 to 2% is where our kind of standard banks are saying they are, with I think NAB being the highest out of all of them. I think, some mortgage stress reports have been coming out lately, talking about kind of the percentage of people that are, 30 days in arrears from another report. And that says, if you look at all lending, in Victoria, it's 2.68%, in New South Wales, 2.49%, with Queensland hit quite hard at 3.64%. So that's, 3.6% of all mortgages that are kind of in arrears today. I think last time we talked about the mortgage cliff, about the amount of loans coming off fixed and going to variable rates. So, jumping probably 300-400 basis points when they come off their fixed. And there was about 1.5 times as many in the next 6 months, including July, it was at that time, as the previous 6 months. And so I was always a bit of a hawk around the RBA probably raising rates at least another 2 times at that stage. With the inflation data, the arrears data, I probably see once in there, maybe, but I see them just waiting. So I see once only if you kind of see maybe inflation data, because we've got such low unemployment. I think they only cared about 2 things, right? Inflation, unemployment. They're supposed to take things like this into account, like arrears and the rest of it. But I think if we have 1 month where inflation might look like it's not doing its standard kind of dropping, they might just press the button once more. But I think other than that, they're going to be quite cautious on the economy, around kind of, they don't want to trigger a housing crash or anything like that. And so, because that will kind of, then counter jobs the other way, I think. And so, yeah, I don't see us kind of lowering rates for, I wish they did, but I don't see them lowering it for a good kind of 6 to 9 months. From now, I think it's going to be a wait. I think we're going to be quite boring for a while, where every rate, we get back to the old, no decision. We just keep rates where they are. That kind of.
Yeah, it'll be fascinating. It'll be a fascinating time for what it's worth. I think a couple of months ago, I reckon my prediction was first rate cut in the latter half of the first quarter next calendar year. But I reckon probably second quarter of next calendar year, we'll probably see our first rate cut for my prediction. But we'll see where it all comes out in the wash, because there's plenty of water to go under the bridge between now and then. So I guess kicking on now onto the next topic in terms of Ash and talking about your role. So senior investment advisor with Evans and Partners, I believe is your title, mate. Correct me if I'm wrong, but I'd love to hear a bit more about the day in the life of an investment advisor for the listeners out there, as to what your role is, what you do. Is it different to a financial advisory role? Just give us a bit of an overview at a high level as to what your role entails, mate. It'd be great to hear from you, and also great for the listeners to know a bit more about your role.
Sure. Yeah. Thanks for that. Investment advisor, as it sounds, I mean, it's very narrow and deep. Is really the way I would think about it. Our focus is primarily, or is effectively solely on helping our clients and investors with managing their investment strategies, and they're effectively helping them define what that end outcome looks like, and then building back from there to build a portfolio across the full spectrum of asset classes that we've got at our disposal to achieve those outcomes with the right level of risk for their circumstances. So there's a lot of similarities to a financial advisor. What I would say is, our role, we probably do tend to work more with wholesale clients as a standard, just because of the breadth of investment opportunities at our disposal. Quite often, a lot of them are wholesale only opportunities, but that's not to say that we don't work with retail investors as well. But we probably do work with more wholesale advisors, and then we will bring in financial advisors who specialize in things like cash flow management, debt management, super structuring strategies, things like that. We'll bring them in to provide that advice when it's appropriate for them, or they might have an ongoing relationship with a financial advisor as well as us, where we're just focusing purely on the portfolio side. And the role it's a fabulous role. It's basically just helping people every day make smart investment decisions and tailoring investment strategies for their circumstances. So, we have some clients who are very, have a high preference for listed investments, where they'll solely have exposure to equities, both Australian and international equities. But for the most part, most clients, I would say, take a multi-asset class approach to investing, where we'll help them manage everything from getting the best cash rate, getting the best term deposits, fixed income, bonds, Australian equities, international equities, alternative assets like infrastructure and private assets. So it's a fun job every day. Wake up in the morning, and you're just on straight away, just looking at what's happened overnight in markets and how that's going to impact the day. And you're just constantly having discussions with clients about their circumstances and how their portfolios can adapt and evolve as the markets do.
Great, mate. Great overview and a good, I guess, high level picture as to what your role is, and I guess the differentiation between an investment advisor and a financial advisor. Because I guess for everyday people, you probably hear about financial advisors more than investment advisors. So it's probably unique in that regard that talk about kind of the other layer, or the next one of the other professions in that kind of sphere of different finance professionals. Brad, anything from your end that jumped out at you there with Ash, or any questions you've got in terms of Ash and his role?
No, I guess from an investment advisor perspective, it'd be, I think we touched on it last time. Unfortunately, didn't make it in, but it'd be a pretty interesting time where you've got some other asset classes that you start to get to look at the moment, where for a while there you're down to quite a limited amount of
cash and equities.
Basically 2 out of more than a handful. What are the ones that you're seeing kind of you're looking at the moment that are outside cash and equities? The interest rates and the rest of it are brought back to kind of from a performance perspective, something interesting.
Things have changed so much in the last 6 months. I think for the 3 years or 4 years prior to the last 12 months, I don't think I spoke to many clients at all about fixed income. And if it was a very small allocation. And
I'm suddenly starting getting a lot of fixed income emails off.
I feel, I feel like I'm a fixed income advisor now at the moment because, firstly, clients have been underweight. So you need, you're looking for opportunities to build that up. But then secondly, there's just really good opportunities there, particularly in Australian fixed income where, where sort of, generally will have quite, slightly wider margins over the cash rate. So it gives you just a little bit of extra return over the risk-free rate for the investment you're going into. Definitely bonds or fixed income as an asset class is an area that we've been spending a lot of time on, that I've been talking to a lot of clients about and building out exposure to.
Come on, mate. That's not super sexy or super exciting, mate. I was waiting for you to bring some exciting, sexy investments to the podcast, mate.
Boring.
Yeah, I know. Sorry, guys.
Repetitive, right? Boring and repetitive.
Yeah.
Just for the pod, because there's some people here that their whole investing life may have been just involved around nothing but equities and cash. So, what is fixed income? Really, really quickly, Ash. There's some people that might not even know.
Yeah, that's a really good question. So if you think about what an equity is just an ownership of a company. So you're owning a share of a company. So that's completely discretionary. Whether you get a dividend is discretionary on the company doing well, the company earning profits, generating profits, and then the company wanting to pay out dividends. And the share price could go up or down depending on the performance of the company. So that's what an equity is. Hopefully you pick good equities and the earnings go up and subsequently the share price goes up. What fixed income is, typically fixed income is not the equity side, but the debt side of a company. So instead of being an equity owner where you have a discretion of profits, or you effectively receive the profits, but it's an unknown whether there will be any or what they'll be. On the debt side, that company, assume it's the same company, just has an obligation to pay an income to the funder, the debt owner. So if it's a bank, then they've got to pay a bank a certain interest rate and the capital back at a certain point in time. But in a lot of cases, investors will be the lender to a company in the form of a bond, or they might do it through a bond fund or whatever the case may be. And effectively, you just get this steady income stream back, which is, as I say, it's an obligation from the institution that has borrowed the funds to pay you back, and then you get the capital back at the end. So fixed income in its when you're thinking about it, it's lower risk because effectively if a company doesn't pay back the bond, they're defaulting. So it's, you, as a bond holder, you'll get something back. As an equity holder, you get nothing back in that situation, in a likely scenario. So it is lower risk, historically lower returning as well, of course. But very good for people who are looking for safe, stable income, stable returns. Often people, close to retirement or in retirement, love this sort of asset class, and fixed income, you can get anywhere from sort of 5% if you're in very safe exposures in fixed income, all the way up to high single digit, sort of low double digit returns if you are in that sexy part of the fixed income space, Joel, where which is sometimes referred to as private credit, where you're obviously taking on a bit more risk in that part of the sleeve of the portfolio.
And there's a secondary market to bonds as well, where they can be bought and sold and traded on the secondary exchange, aren't there? Which can then impact the price of the bond as well.
Yeah, exactly. So you're 100% right. I mean, bonds are quite liquid. The direct bond market is typically only accessible to wholesale investors, but there are some that are tradable on the ASX as well, and there are things called hybrids, which are a sort of a combination of equity and debt, which the banks predominantly, but also the insurers issue on the ASX, which is sort of a quasi bond investment with a little bit more risk. But certainly there's the over-the-counter bond market, which allows investors investors to trade bonds, and the price, depending on if it's a fixed bond, then the price can move around a bit, particularly if interest rates are moving, or the bond expectations of interest rates are moving around. If they're floating rate bonds, you probably get less volatility on the capital side. But look, at the moment, that's an area that we've been very active in.
Sounds like a man that's had many discussions over the past 12 months with clients, with imparting your knowledge there on the bonds, mate. Sounds like many conversations over that period.
Yeah, absolutely. Look, the other areas I think are quite interesting at the moment in the investment world, and this is all general advice, of course.
General in nature as always. General in nature.
Yeah, we need to make sure we put that disclaimer up there. But there's been a huge divergence. If we're going into sort of the more sexy side of portfolios, there's been a huge divergence in the last 12 months between the mega caps and large cap equities in the US particularly, and that sort of small to mid cap side of the market. And that's just what I'm saying there is large companies have performed significantly better than small companies over the last 12 months. Now, interestingly, if you go back 100 years, typically small caps in the US do outperform large caps meaningfully over the cycle. So having a period of such underperformance like we've seen in the last couple of years does, in our view, present quite an interesting opportunity, where both on a real valuation point of view, small to mid caps look interesting. They're trading on about 14 times. The global small to mid caps are trading on about 14 times earnings at the moment, which is below long-term averages. It's quite reasonable. But if you compare where they're trading relative to large companies, they're significantly cheaper. I think it's around 3 standard deviations cheaper than large caps at the moment. So when we're thinking about, or I'm thinking about...
Are you seeing that both domestically and globally, or both, Ash?
Yeah, both, but more so internationally. There's a greater divergence internationally, and a lot of that comes down to the fact that globally, the weightings of Microsoft and Apple and Tesla and Nvidia and the like, are so large in the index. They've sort of pulled up that sort of large mega cap index. The S&P 500 before last night, so it might be a little bit more now, but before last night was up around about 15 to 16% year to date, while the equal weight index was up about 4 to 5%. So, equal weight being, S&P 500 every, 1/500th effectively, the weighting to the index, while the S&P 500 as an index is market weighted. So, these mega caps make up a large proportion. So you can see that big difference there. And so we're seeing that space, that small to mid cap space is really interesting at the moment. We think from a pricing point of view, there's some cushioning there. If the earnings aren't as strong as expected, well, at least you're not paying too much for them. But historically, buying in, at these sort of valuations over the long term, you're going to do pretty well.
Great. Yeah, great recap there on the small to mids and the large caps there. So, and you did bring along a graph for us today, Ash. We love our graphs here at the podcast. So I'm going to share screen quickly for the listeners out there and bring up a bit of graph action. So hopefully for the listeners out there, you might be able to jump on YouTube to check this graph out, or we could possibly put this graph in the podcast links as well for you to bring up on your phone if you're listening. Ash, do you want to run through this graph if you can see it here on the screen, just to explain what this is?
Yeah, and I'll disclaimer this. This is the guys, or Nick Cregan and his team at Fairlight who passed this on to me. They're a small to mid cap global manager. Now, basically, all this is saying is that the difference between valuation of large cap and small to mid cap equities, global equities, and what the yellow line is showing you is where effectively historically the average of where small to mid caps are valued from a price to earnings point of view relative to large caps. And typically, small to mid caps are, let's call it one standard deviation higher than large caps. At the moment, that's over the last 20 years, small to mid caps, approximately one standard deviation ahead of large caps. At the moment, small to mid caps are, 2.5 standard deviations cheaper, maybe even 3 standard deviations cheaper than large caps in that global space, which is, basically it's the cheapest relative it's been in 20 years. So, from my point of view, when you're looking at it's not to say that it's a screaming buy right now or anything like that, and this is all general in nature. But when I'm looking at deploying new funds right now, helping clients, this looks really appealing on a relative basis to other risky assets. So certainly something that we're spending a bit of time on. And look, you can do that in a fund, you can do it in an ETF. There's really cheap ways of doing it, there's expensive ways to do it. But the one thing which is hard, and I would say, is trying to do it directly by buying a few small companies, global companies, is incredibly dangerous. I think you can prosecute ideas like this through a diversified way. Would be my 2 cents.
Seek your own personal advice when it comes to anything that's discussed on the pod. It's just general nature for educational purposes, but a great overview. And I think a picture paints 1,000 words. I went through last week's pod, did the Vanguard graph, which I love bringing that out each year just to see what the markets have done over 30 years now. And I think graphs really help people with that is it right side of the brain, left side of the brain, the creative side, where you can sort of see a picture that can then correlate with what you're hearing. So really appreciate the recap there, Ash. Anything, Brad, that we didn't touch on today that we should have touched on, or Ash, anything we didn't ask you that we should have asked you?
Nothing from me. I think we've done a broad but concise and efficient today.
Ash, anything we didn't ask you today that we should have?
No, I don't think so. You guys are running the show and doing a great job running the show. So I'm here sitting shotgun and enjoying it.
Lovely. And we did have a question from a listener last time, which I'm just trying to remember her name. I think it was Joanne. Apologies, Joanne, if it's not. But she wrote it in, I guess, in terms of, if you remember last time, Ash, the difference between the All Ords here, or the ASX here, versus the Dow Jones in America. And which you answered really well on the podcast. And maybe you can explain to the listeners what the Dow Jones is made up of, and how potentially a better index in America might be better to kind of track against the ASX 200 here, and the difference between the two of them.
Yeah, no, absolutely. So, firstly, the Dow Jones is quite a narrow index. It's only made up of 30 companies. Typically, it does have some of the larger companies like Apple in it, but it's got a lot of the sort of old industrial companies within that index. Probably a little bit more of a sort of a value biased index, I would say. And when you're thinking about comparing the US market to the Australian, the ASX 200, I wouldn't use the Dow as a clean apples with apples comparison, because it doesn't give you a full replication of the US index. It's just 30 companies, and it's like taking 30 of the ASX's older style companies and popping that into an index. I mean, it's not a full replication of the ASX if you did that. So the S&P 500, on the other hand, is really the equivalent of the ASX 200 or ASX 300, if you like, in Australia, and really gives you that similar weighting sort of process. So it's a market weighted index, meaning that the larger companies make up a greater percentage of the index, which is the same as how the ASX 200 works, where BHP, the larger companies, are a bigger proportion of the index, and of course, number 199 and 200 are minuscule and really have little impact on the returns of the ASX 200. So yeah, if you're comparing Australia to the US, I think the cleanest and the best comparison would be the ASX 200 versus the S&P 500.
Yeah, and I'd be interested for maybe the next podcast that we do is to bring up a chart between the difference of the growth of the S&P 500 versus the ASX 200. At a guess, it may not have, the S&P might have grown a bit more than the ASX, because I guess historically in Australia, we're more of a dividend paying nation. We don't tend to reinvest dividends as much as maybe the US does, or they pay lesser dividends. Would that be fair to say, Ash, or is there any difference of opinion there, or where you feel those two graphs might lie if you line them up over 10 or 20 years?
Yeah, no, definitely on the growth side. If it was the ASX 200 without the accumulation part, then you'd certainly see the growth of the S&P 500 greater than the ASX 200. And that's on the basis that the ASX 200, it does pay much higher dividends. So, if you're just looking at growth alone, then you're not looking at the total return of the ASX 200. But over the long term, the ASX 200 has performed very well. It's I don't have the numbers in front of me, but it's relatively comparable to the S&P 500 over a very long period of time. But the S&P 500 has been predominantly growth. There's not a lot of income that you get from those companies. They are typically reinvesting their profits more so back into their companies, while in Australia, particularly with the franking system that we have here, shareholders and boards, see the value in paying out dividends where that franking credit is received. So there is, there's a higher level of income that's paid to investors. So total return wise, though, it has over the very long term, it actually hasn't been too significantly different in Australia and the US.
Interesting. Yeah, great. And Brad, I guess where's the best place for listeners to get questions to us? And thanks for that question there from one of the listeners. It's great to be able to ask that to Ash when he's on today as well.
Yeah, I mean all our social medias. So with Instagram, YouTube, especially just if you've got any questions, dump it into the comments. Don't think Spotify or any of those let any commentary occur. So
Facebook's a good one too.
Facebook's a good one.
Yeah, love it. So I guess in terms of rounding out today's catch up, we've got a third question to throw at Ash and Brad. So the reason we do we named the segment 50-50 is to choose what you like from an investment side of things, but then a life side of things as well. So everything in life has choices, and when it comes to investing, you have choices, but also life choices. So last time, Ash, when we caught up at poker night, I know Ash is a music guy, loves his punk stuff, and I had a really great 50-50. I felt that day, or a third, which didn't make it to air, but I've got a bit of a string off that, which I guess draws along the same lines, but I'm going to narrow it down a bit more. So if you had to listen to only one album out of these bands for the rest of your life, would it be Linkin Park's Hybrid Theory? Would it be Limp Bizkit's Chocolate Starfish? Or would it be Blink-182's Enema of the State? So instead of the band, you don't have all their song selections. You just have the album to listen to for the rest of your life. So
repeat them again. So Enema of the State.
So we got Enema of the State from Blink-182, which was and Ash, you might correct us here, but just Googling it, that seems to be what the pundits say was their best album. Then you've got Chocolate Starfish from Limp Bizkit, which is obviously a smash hit back in the early 2000s, I reckon. And then you've got Hybrid Theory, which was Linkin Park's quoted number one album. So
number one album.
Yeah. So where does that land you? Let's go with Brad first. Brad, out of those three, where does that land you if you just had to listen to one album out of those bands for the rest of your life and you couldn't listen to any of the others?
Pretty sure last time we did this, I was definitely a Blink guy.
You were. Yeah, I think all three of us came with Blink because of the range of songs in there. But we've now narrowed down to albums.
Do you know what? I'm gonna have to change.
Okay.
I'm gonna go. I'm gonna go the Biscuit.
The Biscuit. There you go. First change. Ash, where are you at?
Yeah, I mean that's a great. I'm just looking at the songs on the Limp Bizkit album.
Oh, you've done your research.
It's damn good. Yeah, I'm quickly making sure that I was
There's a wide
thinking
variety.
about the right
There's a
album.
wide variety of
It's good. It's very good, but I'm still going
motivated
to
and
stick
slow.
with. I'm going to stick with Blink-182 because Enema of the State. It's a damn good album, and I think there's enough bangers in there that it'll keep me entertained for the rest of my life.
And did we get the Blink-182 album right? Because there was a couple of when I Google searched it, there was a couple of different rankings. But would that be your number one album?
I'd have to think about it. I mean, yeah, it's got to be up there. Yeah, to be honest, I'd probably say the live album because it has a mixture. If we're allowed to, or that might be Yeah.
You can't do smash hits. You can't do best ofs.
It's about no.
No, love it. And I've said Blink-182 last time, but I reckon I'm going to go to Choc Starfish with Limp. But just the that time period for me, and the album got a lot of rotation, and I think it was one of the early ones where they threw a bit of hip hop in as well to the album too, which was uncharted territory for sort of a punk rock type band, I guess you could say. But there you go. So I didn't go back to the well with the same question because I wanted to get different thoughts there, and we have got different answers, which has been good. So love it. But Ash has stayed true to his Blink-182 band choice there, Ash. So good on you, mate. Respect there.
Got to see him in January. Can't wait.
Oh, seeing in January. Okay.
See him in January.
I'm going to fly back. I've got the tickets. We bought them 18 months ago now. I think.
Beautiful.
About 12 months.
That was another question I was going to think about, was if you had to see one last performance or one last grand final of St Kilda or Blink-182, and they were never going to make it again or never going to perform again, where would you be?
St Kilda every day of the
week.
week.
Being a big Saints man, I thought that would have been too easy.
St Kilda. I mean, come on.
Too easy of a question.
That's too easy of a question.
Don't say go Pies.
Is the year going to be their year this year, Ash? Is it going to be the Saints' year to make it there, or are you feeling like?
I wouldn't have thought so, but you never know. It's an open season.
You wouldn't want to go
so
up against the Pies.
Oh, come on, mate. Prelim Melbourne versus Pies. So we might have to throw a bet on that as a side bet, Brad, where we're going to be at the D's versus the Pies in that prelim. I got tickets yesterday, so I'm pretty excited about going next Thursday night to that one.
Oh, it's going to be massive.
Yeah, cracker.
absolutely.
Sold out.
Absolutely.
Oh, wow. It's going to be massive, like 90K plus, huh?
Yeah, and I'm sure Ash will be along to the Saints game at the G for you guys.
Yep.
The G. Are you happy about being at the G?
I'm fine with that. If we can't beat them at the G, well, then it doesn't matter. So we're going to beat them there. We're going to beat everyone at the G, and happy with that.
Saints fans will be out in force. So
all in the finals. Look at this.
This is absolutely be good. But thanks again for having us on today. So Ash Evans and Partners, been great to have you, mate. I'm sure we'll get you down again in the future. It's terrific to touch on different topics, and all going well, the podcast will air towards the later end of this week. We're on a Wednesday today. Brad, always a pleasure to see you, mate. Listeners, feel free to reach out to us on any of the social media platforms. We love hearing from you, and we'll endeavour to get more guests on as we go through. But without further ado, peace out and have a great day, everyone.
Indeed.
See you guys.
See you guys.